Hello, in this video we're going to look at a tax and a tax cut. In a market with no tax, the supply and demand conditions are given by. So we have our inverse market demand or demand curve here, and our inverse market supply is given second here, our supply curve. We're going to solve for the equilibrium. Got two equations and two unknowns, so we're going to set each equation equal to one another, setting P equal to P. And now we're going to simplify this and solve this for Q. So subtracting 10 from both sides, we get 90. Collecting the Q terms, we get 3Q. Dividing through by 3, the equilibrium quantity is 30. And to get the equilibrium price, we're just going to take this 30 units and plug it back into the demand curve here, and we get an equilibrium price of $40. Now let's suppose the government imposes a $30 per unit tax on sellers. We want to solve for the equilibrium. In this case, the supply curve shifts up by the amount of the $30 tax. So we take our original supply curve here and to shift it up in a parallel fashion by $30, we're going to add 30 to the right-hand side of that equation. Simplifying, we now have our supply curve that incorporates the $30 per unit tax. And once again, we're going to have two equations and two unknowns. So I'm going to set this equation here, this 40 plus Q, equal to this 100 minus 2Q, the demand curve. So setting the P equal to P now, and simplifying. 100 minus 40 is where the 60 is coming from. Once again, collecting the Q terms. Solving for equilibrium, the equilibrium quantity is 20. Plugging this 20 back into the demand equation, what I do down here, we get an equilibrium price of $60. In this case, consumers are paying now $60 per unit. Sellers receive this $60, but then the sellers have to submit the $30 tax to the government, leaving sellers net with 60 minus 30, or $30 for each unit sold. The consumer's tax burden is given by the price that consumers pay with the tax, which is $60, minus the price without the tax. So we found the price without the tax in our first slide, and that was $40. So 60 minus 40, consumers' tax burden here is $20. They're paying $20 more per unit because of this tax. Consumers pay 2/3 of the tax, so consumers are paying $20 more per unit. The total tax per unit is $30, so 20 divided by 30 gives us this 2/3 tax burden being placed on the consumer. As for sellers, the seller's tax burden, the price without the tax we found was $40 in our first slide. The price with the tax is $30, so that's what sellers clear after they submit the tax to the government. So sellers are receiving $10 now less per unit, 40 minus 30. So in terms of the tax burden, the seller's tax burden is 1/3 of the total tax. So we have a $30 tax. Sellers are paying part of that tax, $10 of it, 1/3 of it, in the form of lower prices. Okay, moving on. Suppose the government reduces the tax so that we have a $30 tax now in the market, but the government is going to reduce the tax by $24. How does this tax cut affect the market? So note here that the per unit tax is now $6, which equals the original tax of $30 minus the government cutting some of that tax away, leaving again with $6 total tax in the market. Okay, the supply curve with the tax, as we found earlier, was price equals 40 plus Q. That's incorporating the $30 tax. Well, this is going to shift down now by the size of the tax cut, or $24. So let's incorporate that. So we take our supply curve, and now we're going to shift it down by the size of the tax cut, giving us our new supply curve here of 16 plus Q. Setting that 16 plus Q equal to our original demand curve, and now solving for Q. we're going to get Q equals 28. That is the equilibrium quantity, number of units bought and sold once the tax cut is instituted in the market. To get the equilibrium price, we can take this 28 for Q and plug it into our, plug it into our original demand curve, and we get an equilibrium price here of $44. So sellers are receiving now $44. There is a $6 tax that they still have to submit to the government, not $30 anymore, but just $6 after all taxes were cut by 24. So sellers are netting here $38 per unit. The tax cut received by consumers is going to be the price with the tax, which we found earlier was $60. The price that consumers are now paying with the tax cut, which is $44. So the tax cut received by the consumers is $16. So consumers receive 2/3 of the tax cut in the form of lower prices. The total tax cut was $24. The price didn't fall for consumers by $24. It did fall by 16. So nevertheless, that amounts to a 2/3 here benefit here to consumers. As for the sellers, the tax cut received by the sellers, we're going to calculate that as the price with the tax cut of $38 minus the price with the tax, which was only $30 before. And so sellers are getting $8 more, so they're benefiting from this tax cut. And what does that amount to? Sellers receive 1/3 of the tax cut in the form of higher prices. So 8 divided by 24. So let's sum this up. Buyers paid 2/3 of the tax in the form of higher prices and received 2/3 of the tax cut in the form of lower prices. Sellers paid 1/3 of the tax in the form of lower prices and received 1/3 of the tax cut in the form of higher prices. So in general, the side of the market that bears the largest share of the tax burden is also the side that gains the most benefit from a tax cut. Okay, I'll stop here.